Hello, everyone. Welcome to Deloitte's Debrief Test webcast series in Asia Pacific. Our webcast today is from our Geography Update series, as is titled Capitalize on Hong Kong's New Patent Box Tax Concession. My name is Sarah Chan. I'm a tax partner based in Deloitte, China. I have the pleasure of hosting today's webcast. Together with me, Gavin White, Karen Ng, Chung Yu Hong, and Kenneth Lee will also do a presentation on this topic. Gavin and Yu Hong are tax directors. Karen is our transfer pricing senior manager. Kenneth is a counsel of Chan and Jameson LLP, an independent law firm associated with Deloitte Legal. They are all based in Deloitte, China. You may access our bios on the left-hand side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 15 minutes. So let me go through the agenda for today. First of all, I will quickly go through the key features and the new tax concessions on Patent Box. I will also do a recap of the enhanced R&D expenditure deduction under the Hong Kong tax law. After that, Gavin will, from the perspective of a patent attorney, explain how you should understand your business and to explore the opportunity of patent box regime. After that, Yu Hong and Karen will talk through some intellectual property tax planning ideas and what should be aware of as a taxpayer. Last but not least, Kenneth will talk through how, as a legal advisor, will play a role in the patent box and tax concession planning, and how we can leverage our end-to-end process in achieving the optimal tax impact. Lastly, we will save around 5 to 10 minutes to answer Q&A. Now, let me quickly go through and explain the key features of Patent Box Regime of Hong Kong. The Patent Box Regime law is enacted earlier this month, so it is very new, also very new to Hong Kong, because in the past, we have only research and development expenditure deduction to facilitate companies doing R&D and technology-driven business. But now, with the government's measures and the target to enhance Hong Kong and to improve the competitiveness in making a intellectual property hub in this region, the government has introduced this patent box regime. So with this regime, there are 4 key features we need to be aware of. First of all, the company needs to have R&D activities. Because of these R&D activities, it has to generate a IP. So the R&D activities is referring to the nexus approach that we are going to talk about. That means the more nexus to R&D, the more tax concession would be. So after developing the IP, onshore profits should be generated from that IP. We call it qualified IP income. Hong Kong adopts a territorial source basis of taxation. So that means as long as the profits generated from the IP is onshore source, it is subject to tax. And under this regime, instead of taxing the profits at the 16.5% tax rate, it will be subject to a tax at only 5%. So now, to the next slide, let us first look at So what does it mean by IP under the patent box regime? Under this regime, only three types of IP will be covered: patents, plant variety rights, and copyrighted software. For patents and plant variety rights, these two are governed by certain chapters of the Hong Kong law. And in order to satisfy and to qualify for the patent box regime tax concession, patents and plant variety rights should be registered. Registered either under the Hong Kong law or outside Hong Kong. Even the registration is still processing, that means an application has been filed, companies can still enjoy or apply for the patent box tax concession. One thing to remind is that if there is an overseas IP, that means the IP has been registered or an application has been filed under the law outside Hong Kong, it has to be done before the 5th of July. So this is the deadline for overseas IP to complete the registration or to complete the filing of the registration. Otherwise, it has to be registered under the Hong Kong law. So this is more a grace period the government allow in case company would like to use an overseas IP to generate or to carry on business in Hong Kong. Another interesting thing I would like to highlight is the third type of IP, copyrighted software. This is a pretty special type of IP that would fall within the patent box regime, because for copyrighted software, it needs not to be registered under the Hong Kong law. So it only satisfies the copyrighted ordinance to qualify it is a copyrighted software. So for companies which are development software, and that would be also covered by the patent box regime. And this also gives Hong Kong patent box regime a more generous or more attractive to many other business. So when you look at this, you may ask a question. So whether what you are doing right now, is it the R&D or what the IP, the kinds of IP that you are developing, whether it would be qualified under the patent box regime or not? It makes some sense to exercise certain professional judgment or do some professional assessment to ascertain whether you will be qualified or not. So that's why Gavin later on will also explain a little bit more as a patent attorney how that would work. So two things. One is the timing to register or to file the application for registration of the IP. And the other thing is about legal, because for all those registration and the IP protection, legal advice should be sought. And later on, Kenneth will also talk through this. Next slide, please. So after you have an IP, so one of the three types of the IP I just mentioned earlier, then we have to look at the IP income. So four types of IP income will be subject to the tax concession. So most of them are pretty common. For example, royalties, that means the licensing of the right to use the IP. Disposal gain, that means like you are selling the IP that you have developed. Insurance, because you may claim damages or compensation because of certain infringement of the IP. And for the sales price, this is an interesting part and also needs certain advice from the transfer pricing perspective. Because companies may use the IP to do manufacturing, production, either to produce goods or produce services. So while you are paying a price or you are receiving a proceeds for the sales of products or the services, certain portion of the proceeds should be attributable to that IP. So that means we have to make certain judgment and transfer pricing professional assessment to ascertain how much is the embedded IP income within the sales price. So after we have the IP income, then of course we need to calculate how much tax concession we can enjoy. So when we go to the next slide, this is the formula we have to use. So the amount of profits subject to the 5% tax rate would be the accessible profits from the eligible IP income times an R&D fraction. So first of all, accessible profits. Of course, we have to exercise and make reference to the inland revenue provisions to ascertain the amount of accessible profits. So in general, that is the eligible IP income less all outgoings and expenses in incurring or generating the income, and less all the fixed assets and capital expenditure allowable as a deduction or as a capital allowances under the Inland Revenue Ordinance. So one thing to highlight is that for outgoings and expenses, here we are not just talking about R&D expenditure. Of course, R&D is very important in developing the IP, but when we are talking about generating the IP income, we have to take into account other expenses like sales, marketing, employees, transportation, etc., etc. So this is more like a standalone tax computation in calculating the accessible profits in relation to the eligible IP. So if a company is just a pure IP company, IP owning or IP developing company, it would be very straightforward. But if the company also has other types of business or other types of activities, then you may need to segregate that IP related income and expenditure so that you can calculate the relevant accessible profits. So times R&D fraction. R&D fraction is a very effective way to align with the nexus approach. When you look at the fraction, which is a ratio of eligible R&D expenditure to the total R&D expenditure, you can imagine that the more R&D expenditure which is eligible under the patent box regime, the higher or the bigger the R&D fraction would be. And that means the more the accessible profits could enjoy the 5% tax rate. And bear in mind, the eligible R&D expenditure, which is denominator, can times a 130%. So a 30% markup will be added to the eligible R&D expenditure. And this R&D fraction should be calculated on a cumulative basis. So we'll adopt a cumulative ratio to calculate the accessible profits for each year of assessment. And of course, the R&D fraction should not be more than 100%. So let's go to the next slide to look at what does it mean by eligible R&D expenditure and non-eligible R&D expenditure. So eligible. So when you look at this summary, eligible expenditure in relation to R&D activities that conducted by taxpayer in or outside Hong Kong, if the company outsourced the R&D activities to a third party, those expenditure will also be counted as eligible. So what if the outsourcing is to a related party? It will also be counted as eligible, provided that the associated person is a Hong Kong resident and those R&D activities are undertaken in Hong Kong. So except these three types of R&D expenditure, others will be considered non-eligible. And one thing to bear in mind again is about two types of expenditure. Companies may use financing to develop IP or to finance the business in relation to IP generating income. And some companies also have investment properties. They have factories, they have land or building to build production facilities or laboratory facilities to develop the IP. For these financing costs, that is the interest payments and payments for land and building, they are not qualified either as eligible or non-eligible R&D expenditure and should be excluded when calculating the R&D fraction. So go to the next slide is about cost sharing arrangement. So companies may say, I'm not the only company doing or developing the IP. The IP is developed on a group basis, so the costs are shared amongst all the group companies or the companies that is benefiting from the IP. So in that situation, the RD also accepted that when there is a cost-sharing arrangement and that arrangement satisfies the conditions under DIPN 55, then the cost being shared by the Hong Kong taxpayer can be counted as eligible R&D expenditure. But of course, the conditions should be met. And when you look at all these seven conditions, some are very important as well, relatively important. For example, the participants should derive a mutual and proportional benefits from the R&D activities, and the rights should be co-owned by the participants, and the participants should also be actively doing the R&D. And of course, transfer pricing considerations should be made when determining how much that should be shared by each of the participants. And it comes to transfer pricing consideration as well as an appropriate cost sharing agreement to be signed by the different parties. So now we understand what does it mean by the eligible and non-eligible R&D expenditure, and we calculate the amount of accessible profits that could entitle or subject to the lower 5% tax rate. Let's look at what about a loss is generated. Now go to the next slide. Because some companies may say during the initial stage of first few years, Dash may not be sufficient IP income generator. So how should we treat the loss? The loss, of course, can be carried forward under the Hong Kong tax law without any time limit. This is to offset the future accessible profits generated from the same IP. But what if companies, apart from having the IP business, also have other trading business, for example, trading of other types of goods or other types of businesses, which do not refer or do not relate to the IP. So the concessionary tax loss can also be used to offset against profits from other normal trading business. So when you look at these two examples, example one, while there is a concessionary tax loss, we have to apply a ratio. That is the ratio of 5% to 16.5%, being the 5% tax concessionary tax rate to the standard statutory tax rate of Hong Kong. We have to apply this ratio to recalculate or adjust the amount of loss so that it comes to around $30,000 to offset against the profits from other business. In example two, that is a vice versa situation. That means for concessionary profits, it is a profit case, but for the normal trading case, it is a loss. So in that situation, the concessionary profits can also be used to offset the normal profits. Again, we apply the ratio of the tax rate differential and then to recalculate, to readjust the amount of accessible profits that could be offset against the loss. So go to the next slide. Let me also highlight one very important part of this patent box regime. The patent box regime needs to be filed with a written election. So when you file the tax return, you have to complete a separate forms in order to fill out all the relevant information about the R&D activities, expenditure, and the IP. So once the election is made, it is irrevocable. So it should be very careful to determine the amount of eligible and non-eligible R&D expenditure, as well as the amount of accessible profits generated from the IP. Record keepings are very important. So not just about the financing, but other documents like contracts, invoices, and other intercompanies agreements. And during the transitional period, which is from the year of assessment 2023-24 to 25-26, the RD has agreed that the R&D fraction can be calculated and the R&D expenditure should be kept track on a 3-year rolling basis. It is because while the law is enacted earlier this month, it actually retrospectively give effect starting from 2023-24. So that is allow some grace period and transitional period for taxpayers to dig out all the related expenditure in order to enjoy the tax concession. Okay, this is about patent box regime. I mentioned several times about R&D expenditure deduction. So let me do a very quick recap in the next few slides. So look at the left-hand side. Actually, within the RD, the Inland Revenue Ordinance provisions, there is a Section 16 provisions already contains the amount of research and development expenditure allowed for deduction. And it is a very generic approach to allow deduction, meaning any dollars that you incur, you can get a dollar deduction. Starting from 2018-19, the government introduced an enhanced R&D expenditure deduction policy. Going to the next slide, this is the enhanced deduction. So for expenditure which are qualified as an enhanced R&D expenditure, for the first 2 million, you can get a 300% deduction. For the remaining, you can get a 200% deduction. So it is very generous, but of course, the conditions to be met are very stringent. So when you look at all these bubbles, we stated the requirements and the conditions. First of all, the R&D should be done by the taxpayer itself. So only the in-house R&D cost, people cost, etc., would be counted as qualified R&D expenditure. Another conditions is about the activities. So the activities are also very stringent. It is almost like you are creating something new and also something very groundbreaking. So you have to exercise certain management or also judgment in order to support and substantiate whether those are qualified R&D activities. The R&D activities need to be undertaken all in Hong Kong, and the expenditure should be paid to designated local research institutes in Hong Kong. There are a list of them published in the government website, and only payments to those institutes would be counted. And not to mention, the IP rights ownership should be vested with the Hong Kong entity. This is a good recap for you because when you calculate the assessable profits from the IP income, you have to deduct all these costs. And this is also a refresh for you to think about if you are planning to do R&D or you are planning to develop certain IP, whether you can qualify as an enhanced R&D expenditure and then get the 3 times or 2 times tax deduction. Okay, this is more or less about the patent box regime and R&D expenditure deduction recap. Let me pass the time to the next speaker, Gavin Y. Gavin has newly joined our Deloitte China family. He has a patent attorney background and has been working in the UK and other countries for many years, with particular focus on patent box and R&D tax incentives. So let me pass the time to you, Gavin.
Thank you, Sarah. Hi, everyone. So, like Sarah said, I'm a patent attorney by training, and just as a bit of background to set the scene and provide some context, as well as being a patent attorney, I am also a scientist and engineer. So my interest and area of expertise in relation to these innovation tax incentives is in uncovering and understanding what companies do, and within that, identifying as much qualifying R&D and eligible IP as possible to maximize the benefits from these regimes. And I've worked on helping clients with these for coming up to 10 years now, including 5 years at Deloitte UK in London. So I have a lot of experience working with these types of regimes. Now on this slide, again, as a bit of background, because I think it's useful to know that, or to place into context, although these regimes are relatively new, or in the case of Patent Box, actually new to Hong Kong, they have a long history of being successfully used by governments around the world as a policy tool to encourage companies to invest in R&D. and they've been proven to work. So as you'll see on the bullet point there, a 2020 study looked into the effectiveness of innovation tax incentives in 20 OECD countries and showed that they did boost companies' investments in R&D. And I think out of the 38 OECD countries or thereabouts, more 32 at least have these types of incentives. So they are very prevalent and very kind of good at what they do. The UK, where I used to work, again, has had an R&D tax incentive regime for years and a box regime for over 10 years. They also conducted a similar study and found that, again, these regimes did help boost investment in R&D by up to 10%. So again, very useful tools by the government to essentially try to achieve these aims. And you can see up there on some of the most recent stats from the UK's R&D and patent box regimes. It's showing some significant numbers, both in terms of the numbers of companies claiming these benefits, but also the quantum of benefits themselves. And what's not shown here is a year-on-year increase in both. So, compared to Hong Kong, where I think the most recent stats showed that only 60 companies made use of the R&D enhanced deduction regime in the first 18 to 24 months. It shows that despite all this encouragement from the government, the regime here is really, really underutilized, and there is a lot of room to grow. Before I go into the kind of meaty section, I think we have a polling question for the audience.
Yeah, Gavin, before we go into more detailed discussion in your area, this is the first polling question to ask the audience. So are you using self-developed or contractor developed intellectual properties in your businesses? So please vote. This is to let you think whether this is related to your business or not. But Gavin, as a patent attorney, do you see it is a very big challenge to work with or to support your business owner or to work with finance or tax people in developing or exploring tax incentive R&D or patent box?
I think there is a challenge, yes. I mean, when these rules come out, there's obviously a technical challenge to get to grips with the new rules. New calculations, like you just mentioned in your previous slides, new ways of doing things. But I think the initial challenge, like you said, is these different departments working together if they haven't already, because it's quite a unique environment, and there is that almost a behavioral or even a company-wide cultural change that needs to happen to get comfortable with these new rules, and hopefully I can help people get comfortable with that going through my next few slides. But it's realizing that what you're doing is R&D, what you're doing, a lot of it is potentially patentable or is copyrighted. So yeah, I think there are challenges, at least in the beginning stages, but they are mostly kind of myths, I think, misconception based.
Okay, yeah, thank you. So thank you for making the poll. So here is the result. That's good that 40% of the participants is now using IP in their business, some not, and also 24%. Oh, this is good or not. 24% of them said don't know. So maybe after this webcast, you may know better, or you may want to discuss a little bit more to understand whether you are actually using IP or developing IP or not. Okay, so back to you, Gavin.
Thank you, Sarah. And that is a very interesting result. And I think, along with what I'm going to go through in these next few slides, I think a big reason for this comes down to, like I said, underutilization in these regimes. Not knowing whether you use IP or whether you have IP in your company comes down to some myths and misconceptions. Namely that, in terms of R&D, people place the term R&D on a very high pedestal and think, I need to have a dedicated R&D department, dedicated R&D staff. I need to have a lab, people in lab coats, wearing lab goggles, doing some fancy things. And don't get me wrong, that is most definitely R&D, but it's a lot more than that. Hopefully, this slide helps to change that a little bit, because by broadly ticking these two boxes means, for tax purposes, you are doing R&D. So the first box is that whatever project you're doing, whatever you're doing, must seek to achieve an advance in science or technology. So that's the first box. And then the second box that you also have to tick is that in seeking that advance, you must be resolving scientific or technological uncertainty. So as you can see, obviously being an R&D tax incentive regime. It's R&D based, science technology based, which is where that kind of new unfamiliarity may come in the start. But the definition is very broad, and it's not limited to high-tech companies. And there are lots of different drivers for R&D, not just formal R&D programs that your company has to kind of buy into. And what I mean by that is, if you're a manufacturing company, if you do new product development, new process development, or even existing product development or existing process development, that often can lead to an advance, which ticks the first box. You could be going through normal, what you think are continuous improvement initiatives, introducing robotics, automation, AI, data, that is generating a science or technological advance. So again, could tick that first box as well. Even some things as simple as trying to increase throughput, increase yield, reduce waste. The underlying ambition for this could be to reduce costs. But if you're doing it through science or technology, again, there could be an advance there. And they don't even have to be formal or planned R&D projects. They could start from a problem encountered somewhere that you need to try and understand and fix, or it could even come from a customer complaint, that you don't know the origins of it, so you've got to investigate that. That could also be a trigger for R&D. And building on from that, what you're doing from the R&D doesn't have to be tangible. So it doesn't have to be a new product or a new process or even a new device. It can be intangible. You could be generating new knowledge regarding an existing process or a customer complaint, an existing product. That can also be a trigger for R&D. And another key thing is that success is not a requirement. So what the regime seeks to reward is the effort involved, seeking to achieve the advancement and seeking to resolve the scientific uncertainty. So if you spend lots of time, lots of money going through a program to try and improve something, maybe a product launch, but ultimately it fails, or for business decisions you scrap it, it doesn't matter. If you've incurred the cost, you can still claim the benefits. So again, very worthwhile to know that. Moving on to the next slide. A big misconception, again, is that, I think I mentioned this before, is that it's an R&D tax incentive regime, so it's limited to heavy R&D industries and companies, and it's limited to some of the obvious R&D companies or industries that I've mentioned on the slide at the bottom here. So medical devices, life sciences, pharmaceuticals, electronics, and TMT. And they're definitely applicable. Like I said, they're probably almost definitely doing R&D and qualify for these regimes and doing things that are patentable. But beyond new drug development, clinical trials, for example, in life sciences and pharmaceuticals, that's not where the R&D ends. Again, it could be a problem with manufacturing. It could be a customer complaint. You could be trying to do things to continuously improve manufacturing, increase throughput, reduce cost, reduce waste. That can also be a trigger for R&D. So that's useful to know. But most importantly, I think one of the key myths around this regime is that lots of industries are not eligible, and that's definitely not the case. And I've listed some of them here. So food and beverage, for example, you wouldn't think of probably not think of this industry straight away when you think of R&D. Again, no lab coats, no labs, no lab goggles, that kind of thing. But a lot has been done in this area that again it can be R&D and can be patentable. And it can be as simple as changing an existing recipe or incorporating alternative ingredients into existing recipes. It's not as simple as some people think. It's not always like for like. Sometimes you change one thing, it has a knock-on effect on another. So you've got to investigate and try and figure out how to make it so that you change that ingredient or you change that recipe, but not affect the quality or the stability or the flavor or the taste of that food or beverage. It could be new packaging, new format. Again, reduce waste. It could be an environmental initiative. That could be R&D as well. And again, reducing waste or losses to underlying cost reasons. That could also trigger an R&D project. Construction and civil engineering. No two sites are the same. So even though you're trying to do the same thing in different locations, it could be different challenges. There could be spatial constraints. You could maybe have to develop new ground stabilization or excavation techniques because the ground conditions are different, different stabilities. That could all also qualify. Again, probably not many people think of that industry when I think of R&D, or patents, but a lot going on in that area also. And finally, FSI, insurance, retail, logistics, e-commerce, that's a massively, I think, underutilized area. And industry, players in the industry very, very rarely, of their own accord, look into these regimes because, again, they just don't think it's applicable. No R&D departments, no formal R&D projects. But a lot of what these companies in these industries do is software based, and like Sarah mentioned, software is not only applicable for Patent Box, but it needs to be developed. So again, lots of triggers there for R&D. If you are developing new software, or if you're an insurance company, underwriting platforms capable of handling new or constantly dynamically changing conditions at scale and speed above what's considered the industry standard. Again, copyright there, but also probably a big trigger for R&D and also patenting potentially. If you're seamlessly integrating or trying to integrate legacy and modern technology systems or frameworks, where it's not straightforward and it's not a plug and play, again, probably a lot of R&D going on there. It's not straightforward, lots of uncertainty. But also just things that you think are day-to-day business as usual, but improving scalability or performance where it's not straightforward, developing cross-platform capabilities, they're all triggers for R&D and copyright, software code, and patenting. So definitely worth thinking about because, again, a lot of benefits to be had here, and it's not changing the way you do business or hiring an R&D department. It's uncovering and unlocking what you're already doing to essentially gain these benefits. So moving on then onto Patent Box, it's a similar story. So again, lots of misconceptions and myths around patentable inventions needing to be groundbreaking and Nobel Prize worthy, which as a patent attorney I can tell you is definitely not the case. They can be, and indeed most, I think, in patentable patents, inventions filed as patents are incremental improvements. And like R&D techs, they only need to satisfy really two main criteria. So you'll see on the slide here, the two boxes. First is that the invention must be novel, in other words, new. And the second is that the invention needs to be inventive or non-obvious. You'll notice that this slide looks visually similar to the definition of R&D for tax purposes slide. And the similarities don't just end there, as you'll see from the first two lines underneath the boxes. Often when you're doing R&D and you're seeking an advance in science or technology, the outcome is often new. So not only do you tick that first box for R&D, but actually you also very likely tick the first box for patenting also. Secondly, again, for R&D, if you're doing something that's resolving uncertainty, it's not straightforward inherently. So you're probably also doing something that's non-obvious and inventive. So lots of overlap between these two regimes and the rules. So if you're doing one, it makes sense to look into the other because it can very possibly be, very worthwhile doing both. Two birds, one stone. You save time and cost in looking at both and gaining the benefits from both regimes. And very importantly, I think one thing to note is that patenting does not mean you have to give away your company's secrets to competitors. I mean, yes, patenting means you disclose and make public some of your invention, but not necessarily everything. And the analogy I always go to is that if you buy a recipe book that's written by a famous chef, having it doesn't mean you can cook like that famous chef. There are vital elements, know-how, and built up from years of experience and judgment around how to make things work the way they should. And that should be captured at the same time as finding these patentable inventions and locked away as company secrets. So ultimately, a competitor seeing your patent can't copy exactly what you're doing, but going through this process means that you can file the patent, you can gain the benefits, but at the same time, you also uncover everything around your invention that you can lock within your company's trade secrets and maintain that competitive advantage. So again, two birds, one stone in the sense that you gain the patent box benefits, but also don't give away anything that you don't need to or can't. And again, the last thing I'd like to mention here is that like the R&D enhanced deduction, there's no limitation on industry. So the outcomes of the examples of R&D that I just mentioned, you know, the food and beverage, financial services, insurance, retail, e-commerce, logistics industries, they can all potentially be patentable as well. But moving on to the next slide, like Sarah briefly mentioned earlier, patents are not the only eligible IP for Patent Box, and the Hong Kong regime is actually very, very generous compared to other jurisdictions because other forms of IP are eligible. And the one I want to focus on is copyrighted software, because unlike patents, copyrighted software, like Sarah said, doesn't have to be examined or registered. Essentially, it's an automatic right, and there are just 3 boxes to tick. And if you write the software in-house, the first 2 boxes are essentially automatically ticked because what you're doing is a work and it's literary. So there's only 1 box to tick, and that is to ensure that what you're doing is original. And all that really means is that it's not copied. So as long as it's an intellectual creation from, you know, the mind of your employees in-house, they write the software code themselves, even if they're trying to mimic the function of, you know, existing software outside, but, you know, they write the software code themselves, then that is eligible. On top of that, patents only last up to 20 years with annual renewal fees, and obviously they've got to be registered and go through an examination process, which takes, you know, a number of years. Copyright, on the other hand, can last 50 plus years with no fees payable, and again, it's automatic, so it's pretty much instant, and you don't have to go through years and years of, you know, examination and chopping and changing and arguments with examiners. So it's definitely worth thinking about, you know, especially since I think I mentioned before, essentially, this is just unlocking and revealing what your company is already doing to gain these benefits. You don't have to change the activities you do in your business or hire an R&D team or an R&D department or facility to benefit from these regimes. It's just, again, a bit of a change in mindset and realizing that what you're doing is R&D is patentable. And hopefully that, you know, will change that 24-25% in the poll earlier to a lower number. So moving on to my next and final slide, I think one thing to stress, and you can probably guess this from how much I've banged on about science and technology, is the proven benefit of approaching these types of innovation tax incentives with a multidisciplinary team. Because although it is, you know, a tax regime, the benefit is a tax saving. Nowadays, technology analysis, so essentially starting and leading with identifying qualifying R&D and eligible IP, is the fundamental basis of all innovation tax incentives and, I think, successful claims. Historically, I think when these regimes were kind of in their infancy in other jurisdictions, and companies were starting to try and benefit from them, they considered the application of these rules as a financial data accumulation process. But in that scenario, and we're seeing more and more of this nowadays across lots of jurisdictions in Europe, US, and in APAC, not enough attention was given to the R&D activity and the eligible IP identification, which not only is arguably against the spirit of the regime, but opened companies up to a lot of risk with tax authorities. So the risk internally to the companies of missing eligible R&D and IP, so missing out on eligible tax savings that you can gain, but also with the tax authorities, the risk of non-compliance and lengthy and in-depth questions from these tax authorities around, okay, you've claimed this much and there's this quantum, but what R&D does it relate to? What project does it relate to? What IP does it relate to? How do they relate? And so embracing this multidisciplinary approach and a technology-driven methodology, I think, is very, very beneficial. It helps to remove these risks, give the tax authorities, or in this case, the R&D, and maybe even the Commissioner for Innovation and Technology, if anything is referred to them for review, it gives them confidence that you know what you're doing. Once you've gone through that process, you know, it makes the year-on-year process more comfortable, easier. It gives them confidence, and it ultimately helps avoid what I call avoidable inquiries, which again can be costly from both in terms of time and money. So it's a worthwhile thing to adopt early on. I think adopting this approach also gives transparency as well, which not only helps, you know, companies internally when preparing these types of claims for these regimes to gain these benefits, but again also for the tax authorities. Transparency, I think, nowadays is becoming more and more of a priority in tax. So showing that shows a lot of benefit from both sides. So that brings an end to my section. Hopefully, it's got some of you thinking about the R&D that your companies are doing, and it's helped to dispel some of these myths and misconceptions. But now, kind of carrying on with the theme of the multidisciplinary approach, I want to pass to my colleagues Yuhong and Karen, who will talk about the kind of the tax IP planning piece of the puzzle.
Yeah, sure. Thanks, Gavin. I guess, first of all, from a tax perspective, we can think about the current IP planning strategy. And to be honest, from a Hong Kong perspective, with the effective of the foreign source income exemption regime, what we call in short, the FSIE regime, it actually limits the IP planning strategy from a Hong Kong perspective. Why is that? It's because putting aside the sourcing rules, let's just assume the IP could be treated as offshore income. But starting from 2023, there is a new requirement under the FSI regime, which is the nexus approach, which requires that, first of all, we need to look at the types of IP, right? If the IP is qualified IP, then we need to further look at the nexus approach. But if the IP is not the qualified IP, which means if the IP is not a patent, is not a copyrighted software, then you don't need to consider the nexus approach. You won't get any exemption anyway. But even if the IP is a qualified IP, we still need to look at the nexus approach. What nexus approach is that how much R&D activities you have done in Hong Kong. So in this example, showing in the slides, for example, if the Hong Kong entity just outsourcing all the R&D related services to its overseas related party, and they have done very little things in Hong Kong, under the nexus approach, it can only get a very small portion of the income that could be exempt. So that actually limits the tax planning strategy from a Hong Kong perspective with the effective date of the FSI regime. And I believe there's also transfer pricing concern. So that's why I would love to invite our transfer pricing colleague, Karen, to elaborate a little bit more on this.
Yeah, sure. Thanks, Hong. So for this example, we can see that for the IP owner, which is a Hong Kong company, it does not have any employees in Hong Kong. It does not carry out any R&D in Hong Kong. What it do is just outsource everything related to R&D activities and operations to its overseas related parties. So the problem here will be the tax authority will likely challenge or ask why the Hong Kong IP owner doing nothing is entitled to a very large sum of royalty income or licensing fee by giving the right to use the IP to the licensee. But vice versa, the overseas related party doing almost all the things related to the IP is only entitled to a limited cost plus return. So this gives rise to an issue of there's a mismatch from a TP angle between the people function split between Hong Kong and overseas versus what they receive at the end as their remuneration. And this actually brings out a very key TP concept about how to determine R&D arrangement, which will be illustrated in the next slide. And that is, under the arm's length principle and the OECD guidelines, at all times, TP outcome for operations should be in line with the value contribution done by all the related parties within the same group. So when we talk about the arm's length principle being the first rule of thumb in TP, all related parties' compensation should reflect the functions performed, their risk bear, or the assets used by them during their business operations. So when we talk about functions, it could be your day-to-day on-the-ground work. It could be how you make decision-making for your business operations and supply chain related to the IP, or it can be some oversight on monitoring work. And if we go to risk, we're talking about how you are going to take the risk and what kind of risk you are taking. And all this will add up and determine how you can receive certain kind of return or interests and relevant to the IP. So if we put this into an IP context, the case will be the party who actually carry out the core functions for IP, let's say development, enhancement, maintenance, protection, and exploitation, what we usually could call the DEMP function, and the associate costs they take or by making investment will help to determine who should be entitled to that IP return, let's say royalty or licensing fee. And that is why in the last example, if you're just a legal owner of the IP, actually you may not necessarily get all the return or retain the return in terms of the license fee from in terms of the license fee from the licensee. But instead, the economic owner is more of the OCC's related party, should be the one receiving a majority of the return from the IP. And similarly, if you are just a cash box by putting money into an IP or R&D development, but without doing anything, you may not be able to earn that main return of IP2. Probably you would just receive a risk-free return. So before we are going to move on to the next slide, we would also like to learn from you about your past experience and also your thoughts on some IP planning. Sarah, I'll pass the time to you.
Karen and Hong, thank you again for highlighting the challenges now we are facing, and also because of the international tax development as well as Hong Kong law change, taxpayers need to rethink or to explore other ways to optimize their tax position. So this is a question, the second polling question we have. Oh, it's quick. So people are already answering that. So while they're answering the question, so one quick check with Hong. So what do you think, because of all these challenges, tax development, what do you see? Is there more or less room for companies to explore or implement tax planning, in particular like patent box or IP related tax planning? More or less room?
All right. Thanks, Sarah. I guess before Hong Kong introduced this patent box regime, and because of the international tax development like Pillar 2, I would say that it's becoming more and more difficult to implement IP-related strategy. But luckily, we have this patent box regime in Hong Kong, and in the next couple of slides, I think we can share some high-level planning ideas that may be applicable to our audience, so that they can go back and think about whether these strategies are applicable to them, and if they have IP or R&D related activities conducted in Hong Kong, then I think our audience should take the benefit of this patent box regime and see whether it's applicable to the company in order to achieve a tax saving.
Thank you, Hong. Yeah, the question here is about whether you are exploring options or you are exploring planning opportunities. Now, we have like more than 25% of the respondents saying that they are in the process of exploring different options, which is good, I believe, because with all these regulatory changes, I think we still have a lot of room to think about this. And for those like they are not yet thinking about this, like almost 15%, or others which may not be applicable because they do not have an IP yet. So I think this will also be a information section for Hong and Karen to share more. Okay, back to you, Hong and Karen. Thank you.
Thank you, Sarah. So next slide, please. So yeah, so based on the polling result, it seems that the following case studies will be quite helpful for our audience as well. So for the first case study, it actually illustrates how we're going to determine eligible IP income using the TP concept. So for this example, this Hong Kong company is a IT consulting service provider to external customers. And during the service provision, definitely they will develop some of their in-house software in Hong Kong. And because of the introduction of the patent box regime, they are now trying to see if they can make use of the regime to enjoy the 5% concessionary tax rate. So the question here will be, during the service provision to external customers, the external customers will pay them a lump sum service fee in the amount of $1,000. How we can determine what portion of this that's $1,000 can be seen as eligible IP income in order to enjoy the reduced tax rate. And this leads to the concept of embedded IP income. So in the TP world, if we're going to determine the embedded IP income, it should follow the OECD rules, which include the business profits article as well as the TP concept illustrated in the OECD TP guidelines. So, of course, the TP method to be used will depend case by case and also on the facts and circumstances of how an organization or group arrange their IP or their R&D operations. So we have two scenarios here. The first one will be actually the service provision for IT and the software development is part and parcel and cannot be easily delineated from one another in Hong Kong Co's operations. So what we do is we will use the comparable and controlled price CUP method to try to search in some external database under an independent situation. What will be the level of margin a third-party software company will receive by developing software and license the software to external customers' usage. For example, if the results of the search actually tell that 63% of external revenue of a third-party software company will then become their profit for software development, then what we can do is, first of all, we use that 63% in application to that $1,000 to arrive at $630 being the R&D portion of revenue. And then we minus by the R&D expenses and in total borne by the Hong Kong company to deduce that $30 will be the accounting profit that can be subject to a 5% reduced tax rate under the regime. Another scenario will be Hong Kong Co is actually able to differentiate that R&D is the most valuable and profit-generating function in the supply chain. So we use the residual profit split method to first carve out all those non-R&D, non-IP related function related profit first. Let's say sales and marketing or back office, and let's say it's $80. And then we can then calculate the portion of profit out of 200 by deducting the $80 to arrive at 120 will be attributable to the R&D and IP portion of profit that can use the 5% tax rate. So by comparing these two scenarios, you can tell that if you can substantiate that R&D is a core or critical value driver in your supply chain or business operations, you will be able to arrive at a larger portion of eligible IP income subject to a lower tax rate by using the TP method. So Hong, maybe you can share with us in your next slide some more case study on how our taxpayer can better structure the IP arrangement going forward to take advantage of the regime.
Yeah, sure. In this case study, you can see that on the up-hand side of the slides is a common IP planning strategy that we did before the FSI regime. Basically, Hong Kong just owned the IP and outsourced all the R&D related activity to overseas entities. But such arrangement would not work under the FSI regime anymore, because even if the patent is the qualified IP, we still need to consider the nexus ratio. And if the relevant R&D activities were conducted outside of Hong Kong, it will only give very small portion or even no exemption at all under the FSI regime. So what our audience could consider is, under the patent box regime, we can make use of this regime by moving the IP from a subcontracting arrangement to a cost sharing arrangement. And under the cost sharing arrangement, if you recall, Sarah just mentioned a few minutes ago, the R&D costs that are incurred by the Hong Kong entity could be considered as eligible R&D expenditure. So it would actually increase the numerator in the R&D fraction, so it would help. And of course, we have other consideration under such arrangement as well. because in the past, Hong Kong is the IP owner owning all the IP. But if we move to a CSA arrangement, Hong Kong actually need to share the ownership of the patent with its related party. So there could be a transfer of the existing IP from the Hong Kong entity. So from a Hong Kong perspective, we need to consider whether that transfer would give rise to Hong Kong tax, which means whether we could argue the transfer as capital in nature and then not subject to tax in Hong Kong. And then the second thing is that because going forward, the overseas entity would have ownership in the IP as well. And because of that, initially they would acquire the IP, right? So another consideration would be that whether the acquisition cost from the overseas affiliates perspective, whether it is deductible or whether it could amortize the acquisition costs and things like that. Okay, and I think that's pretty much about the this planning idea, and we can move to the next slide for another idea. In this case study, you may imagine that you already have an entity within your group structure that is the old IP owner. And for example, you set up this entity owning IPs in China, you're already enjoying the high new tax incentive in China, and the tax rate is already reduced to 15% tax rate. But now you learn that Hong Kong has a patent box regime, and the income could be taxed as low as 5%. So some of the client may consider whether it is feasible to transfer the IP from the existing entity outside of Hong Kong to this new IP owning entity in Hong Kong. But I think some consideration that we need to bear in mind is that, for example, we can do so, but because there is a transfer of the IP, we need to consider from the old IP owner's perspective how the sale or capital gain will be taxed in the old IP owner's jurisdiction. And then from Hong Kong's perspective, even though we have this patent box regime, but because of the existing IRO, Inland Revenue Ordinance, there's a provision saying that as long as we acquire the IP from a related party, that acquisition cost will not be deductible. So we need to take this into consideration when we try to implement this idea. But I guess for ongoing operation, one thing that we need to bear in mind is that from the new IP owner's perspective, which is a Hong Kong entity, we need to ensure that we have sufficient R&D people performing the R&D activities work, because by doing so, it would help increase the numerator in the R&D fraction. And then some other consideration, for example, the IP valuation, it actually depends on the IP owner's jurisdiction. For example, if we use China as an example, because it is a transfer of IP between related party, very often in practice, the Chinese tax authority would ask for a valuation of the IP in order to support the arm's length price for the transfer of IP between the old IP owner and the new IP owner in Hong Kong. And then because we need people to perform the R&D activities in Hong Kong going forward, there are actually two ways that we can achieve this. One way is to hire the R&D related people in Hong Kong, and the other way is to try to relocate all those existing employees from the old IP owner to Hong Kong. And if we move the people here, it would involve individual tax consideration, and it would also involve immigration consideration, things like that. But luckily, from Deloitte perspective, this is all we can help our client to do. And going forward, from a Hong Kong perspective, that new IP owner would definitely receive royalty income from overseas, and that would give rise to whether Hong Kong would need to apply for a COL in order to enjoy a lower withholding tax rate. And if Hong Kong really need to pay the withholding tax, we need to consider how much foreign tax credit that the Hong Kong entity could claim. And moving on to the next slide, because if we acquire the IP from a Hong Kong perspective, in the previous example, we learned that the acquisition cost of that IP will not be deductible. And very often when we acquire the IP, the initial cash outlay could be a huge amount. So instead of that, we modify the previous case a bit. Instead of transferring the IP, we just license the IP from the original IP owner to Hong Kong. And then Hong Kong would further develop the IP to make it version 2.0 IP. And the benefit of this arrangement is that from a Hong Kong perspective, we don't need to provide a very huge amount of initial cash outlay. So it would help from a cash flow position. And but similar to the previous example, we still have withholding tax consideration and things like that. And because this is a licensing rather than a sale of IP, we need to better consider how we allocate the people function. For example, how much people should be remaining in the old IP entity and how much people should be moved to the new IP owning entity in Hong Kong. And I think this is somewhere our transfer pricing colleague could help in the arrangement as well. Okay, now I think we have gone through all the case study, and I would like to pass the time to Karen for a quick summary.
Yeah, sure. Thanks, Hong. Can we go to the yeah? Thank you. So I guess after all this, obviously the patent box regime is potentially helpful and beneficial to taxpayers, but you can tell that further consideration will be required, not only upfront or in advance, to see how and whether the patent box regime is something good for your organization, but even during the process, kind of to make sure that a proper IP and R&D operational arrangement is being maintained and implemented in a right manner. So that's why if your organization possesses some sort of factors, it may actually give you a competitive edge to leverage on the patent box regime. So first and foremost, you have to have the free type of eligible IP, and that eligible IP is actually one of the key value driver of your supply chain. So this will be the first and foremost thing for taxpayer to use the patent box regime in a beneficial way. Second, you have to substantiate or demonstrate that you have sufficient or significant business substance in Hong Kong related to R&D. You can do this by having a huge R&D team and abundant R&D staff in Hong Kong, or the Hong Kong company can demonstrate it has extensive contribution to R&D, either by way of engaging some third-party R&D experts to do the R&D work, or try to limit the subcontracting arrangement with overseas related parties. If you really need support and some of your overseas related parties to carry out some of the R&D work for you, try to see if you can convert that subcontracting arrangement into a CSA. So that can actually help beef up the R&D fraction to calculate the concessionary portion of eligible IP income to be subject to 5% tax rate. And finally, it's if you really need to migrate or transfer an IP to Hong Kong code before you use the patent box regime, if that tax cost is considered to be quite minimal and controllable, that will also make the regime worthwhile too. And vice versa, if you don't really have an eligible IP or very critical eligible IP for supply chain, then maybe at this point of time, patent box regime is not yet the thing for you. Or if you have eligible IP already, but you don't have much substance in Hong Kong, try to see if you can do some structuring internally to kind of have a ready in place regime to benefit from the 5% tax rate. And of course, if the tax cost for having an IP migration upfront is very huge, then the cost benefit may not be that beneficial for you at this moment. So some of you may have a question in mind. What if you are subject to Pillar 2 and maybe potentially some sort of top tax in the near future? Is this 5% tax rate under the regime still that beneficial to you? I think, Hong, you have some insights that want to share with our audience on this topic as well, right?
Yeah, sure. Of course, whatever planning that we do nowadays, will need to consider the pillar 2 impact, which means the global minimum tax. For example, Hong Kong has announced that it would implement the global minimum tax rule starting from 2025. So what it means is that, to me, the patent box regime would still be beneficial, in particular for clients who are not within the pillar 2 threshold yet. So for those type of client, they could still take the full benefit from this patent box regime in Hong Kong. And even for those clients who are already within the pillar 2 threshold, which means that for whatever tax saving in Hong Kong, they need to top up the tax to a minimum of 15%. We actually need to consider from a Hong Kong, from a whole jurisdiction perspective, because for most of the cases, I think many of clients will not only have just one entity in Hong Kong, and if they have more than one entity in Hong Kong, when calculating the effective tax rate, we need to calculate it from a jurisdictional basis. So imagine if we have clients that has an entity in Hong Kong enjoying this patent box regime tax at a lower tax rate, but it also has other entity, for example, doing trading, service, and other activities in Hong Kong that are subject to a full 16.5% tax in Hong Kong. We can actually blend this tax together to find an effective tax rate. And so I guess as long as the quantum is significant, the patent box regime will still play a role to help reducing the tax costs of a client in Hong Kong. Back to you, Karen. I guess this is what I would like to share. And moving on to the next section, we would like to pass the time to our counsel, Kenneth, to share about what services offering that we could do from a Deloitte perspective.
Thanks very much, Hong and Karen. Having heard from Sarah, Gavin, and Hong and Karen, by way of summary, you can probably understand that working on the patent box regime requires inputs from a multidisciplinary team of advisors. So that we can take full advantage of the regime, businesses not only need traditional tax advice from the perspective of business process review, the perspective of transfer pricing review, and the ability to obtain advanced rulings from the tax authorities efficiently. But they also need good advice on IP business model optimization, patent filings, as well as documentation. In fact, while this regime is new to the Hong Kong jurisdiction, globally speaking, we at Deloitte have already experienced in Europe with the tax authorities there. And we've been finding that in Europe, the authorities are waking up to the importance of IP, and they're starting to ask in-depth questions about IP-related transactions by businesses, such as the specific intangible assets that any sort of transactions relate to, and whether the quantum being charged under IP transactions are at fair value. And that's where our team comes in. When companies consider IP-related contracting arrangements, they need legal advisors who are not only good lawyers, but aware of the regime's tax implications. So we at Deloitte Legal, operating in Hong Kong as Chan & Jameson, an independent Hong Kong law firm, have years of experience working side by side with Deloitte Tax on all sorts of tax-related submissions. Specifically in terms of the patent box regime, we provide not just tax advice, but as you've seen, Gavin and I together can cover the intellectual property law service offerings, both from patents and copyright angle, as well as supporting the drafting and documenting the diverse amounts of contracts and agreements that you can imagine is required to cover a business's whole IP income generation and R&D life cycle so that they can take advantage of this new regime. I'd also like to take this chance at the end of near the end of the seminar to share some of our recent case experiences and to talk about main challenges that we think clients will face from the legal perspective. And in summary, I think the two main challenges to businesses in Hong Kong are, first of all, identifying their existing IP rights and R&D activities, and second of all, having the proper documentation for all of these activities. So when I mentioned the first challenge being able to identify IP rights, this observation comes from having recently done several cases where we have been advising investment funds with investment-related legal due diligence into tech companies in Hong Kong. And as you remember, Gavin had made the point that you don't need to have a hard science research R&D company to be eligible. And many times, what I see in my work for Deloitte clients in conducting DD and investing in tech companies is I find that these Hong Kong businesses that are targets of investment, they're engaged in innovation and tech, but they often don't, or they're not able to show a ready portfolio of the IP rights that they have. And so they cannot demonstrate to investors that they own valuable, tangible assets, which I think they do. So often only companies in industries that are traditionally revolving around patents, such as medical device or pharmaceutical drug companies, will see management teams having a clear sense of their IP, but elsewhere, not so much. And in particular, what we see is I've been coming across some innovation-oriented Hong Kong new businesses or startup businesses that are very strong in the fintech or prop tech or Web 3.0 space. So they're all providing some sort of tech-enabled service or SaaS products. And while these businesses don't yet own patents, or they sometimes believe that their products aren't at a level where they could be eligible to apply for products because due to innovation and invention angles. But the companies themselves actually generate a lot of know-how and intangible assets during the product development. For example, I'm thinking of a few companies that were in AI. It's a hot topic right now. They're doing AI-assisted climate change and extreme weather risk prediction. They were doing data analytics and financial data aggregation powered by AI. So these companies actually, in fact, in developing these service offerings, they produce a lot of know-how that could take the form of computer algorithms, digital platforms, and code, software code, which actually falls under or may fall under the category of copyrighted software, which, as Gavin already mentioned, and we've been trying to bring this theme out throughout this presentation, is that in Hong Kong, we have a very more liberal eligible IP concept under the patent box regime. We not only include patents, but we're also talking about includes income from copyrighted software. So in those cases, we have been working for, as I mentioned, we were doing DD for investment funds. But when we look at this from the patent box regime perspective, if businesses are eager to understand their own eligibility under this regime to see if they could qualify for tax benefits, Gavin and I can easily turn the DD process around and use our knowledge of IP rights and IP law to assist in reviewing a business's entire portfolio of existing intangible assets and know-how, and see how their current R&D and development life cycles could fit within the concept of eligible IP, including doing a health check, which is like an IP audit, in which we assist businesses to elaborate on whether their current technical know-how can actually fall under the regime, and to assist, if so, help them document these IP assets from a legal perspective. What this involves is a review of existing documentation, such as licenses, joint venture agreements, outsourcing and consulting agreements, etc. And not only that, but the internal processes of a business would also be important. We would need to show, for example, help companies establish good internal policies to identify and protect their copyright works, for example, including the software, and having a good record-keeping procedure so that when challenged, they can provide evidence to substantiate their own creation of ownership of copyrighted software, and confirming that and helping them to establish policies and programs for registration and maintenance of IP assets. Again, I'd like to emphasize that it's not only businesses that where we traditionally think of areas in tech that may be eligible, but not just the prop tech or fintech areas that are common in Hong Kong, but in fact, Gavin and I have been approached by companies recently, even in very traditional industries such as food and beverage or consumer packaged good companies, who we may not traditionally consider them to be a good developer of IP rights, but in fact, all their products and their development processes, the production processes, in fact, could contain a treasure trove of patentable inventions. So working with Gavin, who himself is a qualified patent attorney, our Deloitte legal team would be advising on whether there are any parts of know-how that could be developed into patentable inventions for which a filing can be made. And often we find that discussions about the patent bug regime itself becomes intermixed with discussions about intellectual property rights development and lifecycle management. To take another example of recent case, just this week we were talking to a potential client in the Hong Kong Science and Technology Park. We were asked to come in initially to respond to a query about applying for patents for their speech recognition technology, but it quickly went from talking about IP rights for speech recognition into talking about eligibility for patent box. The management team at that company was aware that there were R&D expenditure tax benefits in Hong Kong, but they had no idea that now that we have the new regime in place, their income from their software could also be covered. So that's the first pain point. And to end off, the second pain point I wanted to quickly talk about is that you can imagine that for all the tax benefits under the regime, you need very significant amounts of documentation to paper it up. So Deloitte Legal has a lot of experience working with tax colleagues to support all forms of tax-related matters in terms of documentation and contract support. And if anyone has read the LegCo papers briefing this regime in particular, they explicitly require that a detailed mechanism of record keeping, and they state this as an essential requirement for eligibility. And to be honest, it's no different from other forms of tax applications, but in terms of the patent box regime specifically, I think things get even more complicated than usual tax applications. Our team earlier, Hong and Karen, already gave a very good introduction to various documentation that may arise from a tax planning exercise revolving around the patent box regime. But for example, you can expect to need, we talked about converting outsourced R&D into cost sharing. So when you put together that cost sharing agreement, you need someone from tax and you need your lawyers to be aware of the tax implications in terms of splitting things between the offshore and offshore entity, making sure the ownership of IP rights is properly delineated, making sure the share and the percentages of expenditures would properly give you the maximum tax benefit. We talked about IP migration, and when you transfer the IP, you need to make sure you have the proper assignment agreements to make sure if you have patents, whether the registrations are properly transferred, whether ownership has properly moved from one party to another. We talked about license agreements in the sense of generating income, as well as having two companies, one company, the old IP owner, doing version 1 of the IP, licensing out to a newer company, generating version 2 of the IP through a license agreement. So all of those agreements will have to clearly delineate if there's a difference in the IP being generated, what is the costing that's associated, so that you can be properly getting the maximum income tax benefit eligibility. And finally, in terms of R&D personnel expenditures, you have service agreements, you have employment agreements. You need to make sure that it's properly documenting any expenditures incurred go into the Hong Kong entity. In any case, it's not just for the patent box regime to end off. I think properly documenting IP assets from a legal perspective is important for protection. And I guess I'll end off with a final example. A few weeks ago, I had a sort of a panic phone call from a potential client. He is from a Hong Kong computer software company. And he just found out that one of his key employees was a software developer for him, joined a competing company pretty much right after resigning from his current job. So this business owner, he had no evidence that his former employee had run away and stolen any company secrets, or at this point had engaged in IP infringement. But he's really concerned that this employee would then go, after he's gone to his competitors will be replicating the company's existing software, and he had no idea what to do. So in this case, what they should have done is that when entering into employment agreements, whatever employment relationship that was signed should have included non-compete agreements wherein they say they shouldn't have been, this employee should not have been allowed to work for a competitor within a short period of time, or it should include adequate confidentiality protections and provisions as to IP ownership over any work products during their employment. I guess the point I'm trying to bring up is that when we're looking at the patent box regime, we need to realize that businesses don't just need advice. We need very good advice on the tax side, but simultaneously, holistic and all-rounded support on the whole IP life cycle is essential. And our team at Deloitte is here to do just that. Thanks a lot. So, and now I'll hand it back over to Sarah for closing remarks.
Thank you, Kenneth. Patent box regime is just enacted in Hong Kong, but it is not new. I'm glad that we have speakers in today's webcast covering different expertise, tax, business, patent, as well as legal. So, and also I believe that with all these expertise, we should have already given you a new way of thinking about your business. So please spend some time to think about your business, current and future, and to see whether you can make use of this patent box regime. I'm glad that Hong already said there is still room to plan to implement tax efficient way to structure the IP ownership and IP operation. So feel free to reach out to any one of us. So this brings us to the end of our today's discussion. Let's open the floor to check if there is any question in the Q&A box. We still have a few minutes to address the questions. There's a question submitted referring to the presentation deck, slide number 32. So it is regarding a transfer of the IP to the NewCo, which is a Hong Kong company. So with that transfer, should it be at book cost, or do we need to do a valuation for the IP transfer? So maybe I'll pass this question to Karen to address from a transfer pricing perspective first.
Yeah, sure. Thank you, Sarah. So I guess for this situation, provided that the original IP co and the new Hong Kong company is related party, then of course we need to look at the arm's length principle under OECD to determine what sort of pricing will be being considered by the tax authority as being reasonable. So usually when we set reasonable pricing, that means it's an arm's length pricing, it's a market comparable pricing. So in this case, an independent valuation is suggested to kind of evaluate what will be the price or the value of the IP, because if it's under a totally external or independent situation, a company won't just transfer the IP at cost without any premium or without any top of value to another non-related parties. So from a TB angle, a valuation which can actually represent what would be the latest market condition, looking at this IP value is generally suggested. But I guess from a corporate tax angle, there may be some other considerations to take care of too, right, Sarah?
Yeah, that's right. And Hong already mentioned in that example, is about the acquisition cost of the IP would not be allowed for deduction. But one thing I would like to add is under this patent box regime, in a situation that if the original owner is a Hong Kong company, and then as a NewCo, you acquired that original Hong Kong owner, either through amalgamation or just through an acquisition of the shares, equity interest. And after that acquisition, you also acquired the IP. Those costs, that is the eligible research and development expenditure already incurred by the original owner, could be picked up by the new IP owner. So that is also one, I would say, beneficial treatments that the RD allowed, and also to encourage companies while you're thinking about investing into developing IP patents. So what about you also acquired a company which is already doing that, so that you can inherit the outcome and also the expenditure and benefit from those investments when calculating the R&D fraction, and to optimize the tax efficiency. So this is one point I would like to add as a remark. So let me check again if there are any other questions. So I mentioned earlier at the start of the webcast that feel free to send your questions after the webcast. So we'll try to answer the questions in the next few weeks. So because of time limitation, that unfortunately we have to close the section. Gavin, Karen, Hong, and Kenneth, thank you again. And also special thanks to all of you who were able to join us today. We encourage you to fill out a short survey that will pop up on your screen momentarily, and tell us what you think about today's program. If you join us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon, or have them visit our Debriefs website. We'll respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of other questions or comments later, feel free to reach out either to me or any of the speakers today. We'll be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Geography Updates, Australia's new thin capitalization rule, implications for real estate investment. And last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.